Goldman Sachs co-head of global commodities research, Daan Struyven. Daan, there's been so much energy talk, especially considering what's going on in the Middle East. But just quickly on this potential for consolidation between two pretty large energy names in the global world. What would that do to oil prices, if you could anticipate?
Yeah, great. So as the commodity strategist, I can talk about broader market trends, won't comment on market specific names. But I think that we have seen a lot of consolidation in the sector over the last couple of years. There are good reasons to think that this is going to continue. Structurally, energy companies are focused on capital discipline. And in environments where shareholders are focused on capital discipline, you're going to allocate your incremental dollars not to organic growth. You're mostly looking for cost-saving opportunities and for M&A opportunities. Cyclically, in our view, oil prices are going to decline another $10 per barrel or so by year end. And that means that it may be a good time to buy companies at a relatively low price, especially if your own valuation is higher than your target, or if you have cash on hand to contribute to funding the transaction.
Hold up, we're at $65.24. You say by year end we'll be at $54 a barrel?
We think for WTI we'll be in the mid-50s, for Brent in the high 50s. So yeah, roughly $10 per barrel lower by year end. The market has been super focused on geopolitical supply disruption fears over the last 2 or 3 weeks. We think the market is going to increasingly focus back, assuming no supply disruptions, on the supply and demand fundamentals. And we think that supply growth this year will be almost 4 times stronger than demand growth. We have seen significant inventory builds outside of the US.
Right, because let me just say that today we got weekly inventories. They were down markedly for the 5th week in a row. And when you look at how much they were down, I mean, the expectation for crude was for a draw of just about 797,000 barrels. And instead, we saw a drawdown of 5.8 million barrels. So somebody's using up a lot of energy. Plus, it's about 1 billion degrees in the third eastern half of the United States at the moment. I mean, we can show you some of the temperatures on this nationwide heat map. 96 in New York, Boston 93, Detroit 80. Baltimore's really hot in the 90s there. Raleigh 96, and these were all hotter yesterday. So what does that do for natural gas as well? I should ask you about that, because that powers air conditioning.
Yeah, exactly. So power markets, we think, in the US are really at a significant risk of summer price spikes and even shortages. Structurally, we think the power market is getting a lot tighter. This summer is on track to be very, very hot. And it's quite unusual, but we're now actually seeing in the data over the last few days that some places are starting to use oil again to generate power. We typically haven't been doing that.
Because it was expensive.
It was expensive. And to prevent outages, you see both a ramp up in natural gas supply, coal supply, and oil supply for power generation. We need all these sources. More broadly, though, to your point on US crude inventories, what we have been seeing year to date is pretty significant rises in global crude inventories, about 1.3 million barrels per day on average year to date. But in the last few weeks, we have seen big draws in the US, but builds elsewhere. Perhaps some Asian economies where we have seen significant inventory builds in the context of the Middle East escalating, were importing more, building up stockpiles, perhaps to ensure from a precaution perspective against the potential drop in supply.
Right. Okay. So the Mideast, let's talk about that. It is fascinating to see what the oil market and prices did on Monday and Tuesday after B-2 bombers dropped these bunker buster bombs on Iran. Everybody thought, oh, this is going to make oil spike. Now, Sunday night, oil jumped about 4%. I was being a geek and watching that.
You're not alone.
I'm sure you were too.
It was a busy Sunday.
How surprised were you that Monday oil fell 7% and then another 5 or 6% yesterday?
Yeah, it has been an incredible round trip. We're basically only $2 higher than where we were 2 weeks ago. So the geopolitical risk premium in oil prices is very modest.
What does that
at the
tell
moment.
you?
I think the oil market has gotten very quick in pricing out geopolitical risks. It became clear to most market participants when Iran's response was quite muted that the probability of disruptions to the Strait of Hormuz dropped very significantly. And as soon as markets gained confidence in that view, you saw a super significant drop in prices that then was amplified by the announcement of a ceasefire between Iran and Israel.
Before you go, you cover all commodities. Gold. Gold has been on a tear over the past year. Obviously, it really sold off yesterday, more than $50 per ounce. Today, it is just slightly higher by about $15 to $3,349. Your forecast for gold prices?
Yeah, so our message to investors remains go for gold. We have gold rising to $4,000 per troy ounce over the next 12 months. At the moment, speculative positioning is quite low. So it's actually a pretty attractive entry point. The main sea change in gold markets since 2022 has been the fivefold increase in buying by central banks. Because since the freeze of the Russian central bank asset reserves in 2022, many central banks had this wake-up call, realizing that the only asset that's necessarily safe and can't be confiscated if you hold it in your own vaults, it's gold. We just got a survey from the World Gold Council surveying more than 70 central banks globally, and we had record high purchase intentions for gold. None of the surveyed central banks was actually planning to sell gold over the next 12 months.
Great to see you, Daan.
Thanks a lot. Great to see you.
It's a fascinating world you're in right now, especially with the energy complex. We
Absolutely.
appreciate you coming on.